Welcome to XRP Pro Ledger. Today we need to address something directly before we get into the data, because the gap between what XRP's price chart is showing and what the underlying market structure is doing has never been wider in this entire cycle. And failing to understand that gap is the analytical error that is going to cost the most retail investors the most money in the months ahead. XRP is consolidating in a tight $1.42 to $1.43 range right now. The chart looks flat, the daily candle is unremarkable, and if your entire analytical framework begins and ends with price, you are looking at a boring sideways session with no actionable signal. But beneath that flat price, three things happened today that deserve your complete attention. Santiment on-chain data confirmed that exactly 34.94 million XRP was drained from centralized exchanges and moved into private cold wallets in a single session, the sixth largest single-day outflow of 2026. April inflows for US spot XRP ETFs officially crossed the $75 million monthly milestone, with cumulative inflows hitting approximately $1.30 billion. With Franklin Templeton's XRPZ product alone acquiring $3.89 million in a single day. And 120 major crypto firms, including Ripple, Coinbase, and Kraken, sent a formal joint letter to the US Senate demanding an immediate vote on the Clarity Act. Stay with this analysis through the end, because I am going to walk through Standard Chartered's specific price modeling methodology and explain precisely why their $5 to $10 year-end target is a liquidity mathematics conclusion rather than a speculative projection. Let us establish the precise technical framework before we address the supply shock data, because the $1.40 support level that is holding as a structural floor in today's session is not simply a chart level. It is the price at which the accumulated institutional buying over the past several weeks has established a demand absorption zone, a zone of sufficient depth to prevent meaningful downside penetration. When a price level holds as support through multiple sessions, through geopolitical uncertainty, legislative delay, and retail sentiment deterioration, without breaking, the analytical conclusion is not that the market is indifferent to the negative news. It is that the buyers at that level have greater aggregate conviction and greater aggregate capital than the sellers attempting to push through it. The $1.40 structural floor in the current environment is the visible evidence of institutional demand absorption operating at a scale that retail selling cannot overcome. Above the current consolidation range, $1.87 is the resistance zone that technical analysts are mapping. The next meaningful target on a confirmed break above $1.53, a resistance level that the combined pressure of today's supply shock, ETF inflows, and legislative catalysts could provide the sustained momentum to breach. The tight $1.42 to $1.43 range is not indecision, it is compression preceding directional resolution, and the direction of the underlying data is unambiguous. The 34.94 million XRP drained from centralized exchanges in a single session is the supply-side signal that requires the most precise analytical treatment, because the specific context of it being the sixth largest single-day outflow of 2026 provides a ranking that tells you something important about the velocity and scale of the accumulation phase currently underway. Sixth largest single-day outflow of 2026 means that 5 sessions this year produced larger outflows, and collectively, those 6 sessions represent the most concentrated supply removal from liquid circulation that this market has experienced in the current cycle. Each of those sessions produced the same observable pattern: price consolidation on the surface, while on-chain data confirmed massive supply reduction in the background. The entities executing these transfers are not retail investors moving funds to hardware wallets for security reasons. The capital scale required to move 34.94 million XRP, approximately $50 million in dollar-denominated value at current prices, in a single coordinated session, that implies treasury-level decision-making, compliance oversight, and investment committee approval processes that are entirely inconsistent with retail behavior. These are institutional or near-institutional entities, making a documented, deliberate decision to remove XRP from exchange-accessible positions and place it in cold storage structures that require significant time and operational effort to reverse. The implication is straightforward. The entities executing these transfers do not anticipate needing to liquidate these positions at current prices. There is a specific number that emerges when you aggregate the supply compression data across today's session and the broader accumulation pattern of recent weeks. And I want to walk through that arithmetic precisely, because it changes the framing of the current price consolidation in a way that most retail-focused analysis is not capturing. The 34.94 million XRP in today's exchange outflows sits on top of a cumulative ETF custody position of approximately 769 million XRP, currently held across 7 US spot products, adding the cold wallet transfers tracked in recent sessions. The total supply removed from liquid exchange accessible circulation during the current accumulation phase is approaching a massive figure, a figure that represents a meaningful percentage of the total daily trading volume available to institutional buyers attempting to build positions at scale. When demand for an asset increases, as it will when the Clarity Act's 14 new bank powers unlock institutional capital that is currently waiting for legislative clearance, and the available liquid supply has been systematically compressed through the exchange outflow pattern we are documenting. The price response is not gradual. It is a rapid adjustment to the new supply-demand equilibrium that the compressed order books can support. The calm before a supply-side crisis is not a metaphor in this context. It is a measurable, documented arithmetic reality that the current price chart is not yet reflecting. I will address the specific legislative catalyst that is scheduled to trigger that demand acceleration later in this analysis. The joint letter from 120 major crypto firms to the US Senate is the coordinated institutional political action that most retail commentary is treating as a background news item, and that institutional political analysts are treating as a significant escalation, an escalation in the legislative pressure campaign around the Clarity Act. 120 firms, including Ripple, Coinbase, and Kraken, representing collectively tens of billions in market capitalization, millions of customers, and significant political donation capacity, coordinating to send a formal joint letter demanding an immediate Senate vote is not a routine lobbying activity. It is a coordinated public pressure escalation, designed to create political accountability for senators who continue to delay markup and floor votes on legislation that has been building bipartisan support for years. The specific demand for an immediate vote is significant because it shifts the political dynamic from passive support to active pressure. Senators who were previously comfortable allowing the timeline to slip into May and beyond now face a documented public record, a record of 120 firms demanding action that can be referenced in constituent communications, donor conversations, and media coverage. The political cost of continued delay has increased materially with this letter, and the corresponding probability that the Senate Banking Committee accelerates its timeline in response to that increased cost has increased proportionally. The Standard Chartered price target of $5 to $10 by year-end deserves a precise analytical engagement rather than either celebration or dismissal. Because Standard Chartered is not a speculative crypto research outlet, it is a major global banking institution whose research division stakes its professional credibility on the accuracy of its modeling methodology. When Standard Chartered publishes a price target that is conditional on a specific catalyst, in this case, a successful Senate vote on the Clarity Act, they are communicating a quantitative model output, an output that reflects their institutional assessment of the capital flows that would follow that legislative event. The $4 billion to $10 billion in additional institutional inflows that various analysts have projected following Clarity Act passage, that represents the capital from pension funds, endowments, and sovereign wealth funds, whose investment mandates require legislative rather than judicial regulatory clarity before authorizing full digital asset allocation. At current XRP market cap levels in the $91 billion range, an additional $4 billion to $10 billion in institutional inflows, competing for supply that has been compressed by 34.94 million XRP in a single day, plus hundreds of millions in ETF custody. That produces a price impact that Standard Chartered's liquidity modeling maps to the $5 to $10 range. That target is not a wish. It is a capital flow model output from one of the world's most respected institutional research teams, applied to the specific supply-demand mechanics of the current XRP market structure. The International Finance Bank confirmation that XRP is operating as a live payment rail for their institution is the real-world utility signal. It connects the investment thesis to the operational deployment reality in a way that supply compression data and legislative analysis alone cannot capture. Real-world utility deployment is the mechanism through which XRP generates transactional demand that is independent of investment demand, demand that is driven by operational necessity rather than portfolio allocation decisions, and that therefore persists through market cycles, legislative delays, and geopolitical uncertainty without diminishing. When a financial institution publicly confirms that XRP is functioning as their live payment rail, they are not making an investment statement. They are making an operational statement. The XRP ledger is processing their actual transactions, their actual client funds, and their actual cross-border settlements in a production environment. Every institution that makes that confirmation provides a data point that every other institution evaluating XRP for operational deployment uses in their own due diligence process. The network effect of operational deployment is different from the network effect of investment adoption. It builds more slowly, but with greater structural permanence, because institutions that have integrated XRP into their operational payment infrastructure have switching costs that investment holders do not. The International Finance Bank confirmation adds one more institution to the operational deployment network, a network that makes XRP progressively harder to displace from the payment infrastructure role it is building. The Franklin Templeton XRPZ single-day acquisition of $3.89 million is the specific institutional behavior signal that deserves isolation for analysis. Because Franklin Templeton is not a crypto-native firm making speculative allocations, it is a $1.50 trillion asset manager whose investment decisions in regulated financial products are subject to the same fiduciary standards and compliance oversight that govern every other allocation they make for their clients. Franklin Templeton acquiring $3.89 million in XRP through their XRPZ ETF product, on a day characterized by geopolitical deadline expiration, legislative odds deterioration, and flat price action. That is the institutional equivalent of a value investor buying into a sell-off. The decision to deploy that capital on this specific day, rather than waiting for the geopolitical and legislative picture to clarify, reflects a specific institutional assessment, an assessment that the current price level represents better risk-adjusted value than the price levels that will exist after the surface-level uncertainty resolves. Franklin Templeton's investment committee does not make $3.89 million single-day decisions based on daily chart patterns or polymarket odds movements. They make them based on fundamental supply-demand analysis, regulatory trajectory modeling, and long-term institutional adoption curve projections that are independent of today's headlines. Their decision to buy today in this environment at these prices is the institutional equivalent of a clear directional signal embedded in a transaction record that is publicly verifiable. The $75 million April ETF inflow milestone is the monthly aggregate figure that provides the velocity context for the daily inflow data we have been tracking. And understanding the velocity of ETF inflow growth is essential for projecting where cumulative AUM will sit when the Clarity Act legislative catalyst arrives. April's $75 million milestone represents the strongest monthly ETF inflow figure since the products launched in late 2025. It is building on the $65 million figure that was the weekly record broken recently, meaning the pace of institutional capital deployment through ETF channels is accelerating rather than stabilizing. If that acceleration continues through May at even a conservative multiple of the current daily run rate, the cumulative AUM figure at the time of a Clarity Act Senate vote could be substantially higher than the current $1.30 billion. The significance of that AUM trajectory for the supply compression analysis is specific. Every dollar of ETF inflow removes proportional XRP from the liquid market permanently for the duration of that institutional position, and the institutional positions built through regulated ETF products tend to have longer holding periods than on-chain wallet accumulation positions, because they are governed by investment mandates with defined holding period requirements. The supply compression that the $75 million April milestone represents is not temporary positioning ahead of a specific catalyst, it is structural, long-duration supply removal that narrows the order book depth available to future institutional buyers entering at higher prices. The complete structural picture that today's data assembles. The 34.94 million XRP, sixth largest single-day outflow of 2026. The $75 million April ETF inflow milestone, with Franklin Templeton alone acquiring $3.89 million in one session. The 120-firm joint letter creating measurable political pressure on the Senate Clarity Act timeline. The International Finance Bank operational deployment confirmation. The $1.40 structural floor holding through maximum retail uncertainty. And the $1.87 technical resistance zone that a supply-constrained order book will struggle to contain when institutional demand accelerates. This is a picture of an asset in the final phase of its accumulation cycle before a supply-side crisis that the current price does not reflect. The retail investors who look at the $1.42 to $1.43 consolidation and conclude that nothing is happening are reading the surface correctly. Nothing is happening on the price chart. Everything is happening in the supply structure. The 34.94 million XRP that moved to cold storage today will not be available for institutional buyers when the Clarity Act passes and the standard chartered $5 to $10 capital flow model activates. The 769 million in ETF custody will not be liquidated because a daily candle looks unremarkable. The 120 firms that sent a joint letter to the Senate today will not withdraw that letter because retail sentiment is neutral. The calm before a supply-side crisis is the specific market condition that produces the largest and most rapid repricing events in asset market history. And the documentation confirming that we are in that condition has never been more complete. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.